the Sunday, August the 21st. The summer is winding down, and in that people are slowly crawling their way back to the offices or their remote offices, if indeed they're still allowed to have them, like Adi and Christoph. I think you will become perhaps a rare breed of those who still have the entitlement of working from wherever they like on any day of the week. But it does sound like the big office return is underway in all of the big financial centers. Anyway, what's happened with oil prices since we left, everybody? I think ultimately they are hovering closer now to $100 a barrel, under 100 obviously on Brent, which is trading ended the week this week at about a little above 96, nearly $97, having, it would appear, tested moving with WTI below 90, but it held, the floor held, and that sort of 100 minus 500 plus 5 still seems to be the dominant zone in which oil prices want to sit. We've much to talk about, obviously, week in review, month in review, really, week ahead, month ahead, and we'll have to sort of take that sort of perspective this morning. And we welcome back Christoph Ruhl, Senior Research Scholar, Center on Global Energy Policy, Columbia University. Christoph, while everybody was sunbathing on the beach, I saw you were active across many television channels and platforms, so you were obviously paying attention to what was going on in the world. What did we miss?
Not much. I was traveling, that makes the difference. I think what we have is a bit in the middle of the summer lull on the markets, a bit of a maybe, how do they call this, a summer rally, which probably won't tell us very much because, yes, prices went up everywhere, equity share prices went up, but it was very, very thin trading. On the political front, which I should have mentioned first, on the war front, picking up of the Ukrainian ability to strike behind Russian lines, but it also becomes increasingly obvious, for reasons which are not clear to me, that Ukraine doesn't seem to be capable of mustering the number of soldiers it needs to have really make use of these weapons and launch a successful counterattack. I mean, there was always talk about getting 1 million people. There's martial law and all of that. But my suspicion is that the enthusiasm for defending the fatherland is probably on the ground a lot smaller than in the Western media. And that's what we are seeing.
But so nonetheless, we have seen that sort of development of bombs exploding in Crimea. That's slightly some kind of new piece.
Yeah, that's what I said. So the ability to strike behind the front lines, an amazingly quick adaptation of these complicated Western weapon systems, but you have to at some point make use of it. The long-run danger here is that if this turns into a stalemate and then all the media and everybody from the outside, being more or less like all of us, not knowing what's going on really, would conclude it's a stalemate, then this will severely undermine funding capacity, their capacity to raise Western funding. In particular, since it's not only about shipping weapon systems, but increasingly about the budget. And it's a different story of telling freezing Central Europeans we need some more billions for our budget than it is we need some of your old tanks. Well, it's going to be a harder sell to the population and the politicians in the West. That's, of course, what Russia is betting on. And then on energy, I think the big divergence between oil and gas, I still have a slight disagreement with your the predictions of the oil price. I still think the trend is downwards. That's what we see. Volatility is huge, obviously, because the safety margins are small. But now also forecasts converging to an excess supply in the third and the fourth quarter by most forecasters. So signs tend more towards 80 to 90, I think, with this big volatility, which makes it very difficult to predict. Then towards 110, 120 in that spectre. And then on gas, everything points toward a big conflict in the winter, I think, because Russia has lost now so much gas already of their shipments into Europe, and they must be knowing that they're unlikely to get it back. And what this means is there's very little to lose for them, but probably something to gain by increasing the pressure towards the winter. That's what everybody here in Germany, at least, is getting ready for.
Well, let's welcome back Adi Imsirovic, Senior Research Fellow at the Oxford Institute of Energy Studies. Adi, your thoughts on what were the big sort of themes over the last month? Ultimately, your insights on the oil price. Christoph still thinks there's a downward trend there, even though we had a pop-up at the end of last week. The 100 +5, -5 still seems to be the window to me. Your thoughts?
Well, before I go into predictions, let's just see what's really been happening.
Yeah.
It's I think the most notable thing in the oil market has been a rapid disappearance of steep backwardation. Just to give you an example, I think last time, and I think if I was OPEC, I'd be really worried about that, because obviously the first thing you want to get is strong front end of the month backwardation, roll that backwardation forward, and then support those high prices if you're a cartel. That's disappeared, and we've seen a remarkable weakness in the market. Why at the front end? Why weakness? Well, I think first we've had record US exports of about 5 million barrels. We've had a low China demand. We can come back to all these points later. I won't go into detail. We've seen a return of Libya back in the market. So essentially, we had a number of things that actually supplied the market very, very well. Probably the last one being also continued Russian exports into Asia. But I think just in terms of backwardation, to give you an example how much we've lost, I think last time I was on your show with Christoph there, it was the front end CFD, which is dated to frontline Brent, was about $10. If you remember, you know what? Currently, next week is trading 14 cents over the front month. So we're basically flat. We're talking cents, not dollars anymore. The front month spreads as well. The front spread is 69 cents closed on Friday. That's well below dollar. And the following two are hovering just about $1. Last time I was on the show, it was well over $3 on pretty much all of them. So the market's really literally kind of deflated completely at the front end. We see record, also we see buildup in gas oil stocks in ARA in European area. And that was one of the big tight moments for the oil market. There was this shortage of gas oil in Europe. Now we have plenty, partly has to do with Rhine levels and so on. So I won't go too much into that, but the stocks in ARA are pretty high. Generally, China has started building stocks, oil stocks, even, and they've actually been doing it throughout the year anyway, about 1 million barrels a day due to low demand. So not terribly bullish. Now, just the last point is just when you get before you decide to get terribly bearish, we've had a suspension of loading at CPC in Novorossiysk. 2 out of 3 buoys, 2 are out again. Total loading from the country is about 1.4 million barrels. So we could overnight lose another 1 million barrels. This is Putin playing games again, almost certainly. We have to see exactly what's going on. It could come back in days. We don't know, but we have to find out what's going on. So volatility again. One thing you can be assured what's going to happen. We're going to get volatility in this market.
Well, Christoph, let's dig into the China piece of obviously the different pillars of this energy market, this global economy, you might say. But you have been, and others obviously, relatively optimistic or positive about the China stimulus that was to come, the recovery post-COVID. Here we have the world's largest oil importer, clearly operating on kind of one leg at the moment. Oil imports significantly down, etc., although inventory is building because consumption is down. But it wouldn't take much of a pop for China to wake up tomorrow morning and say, okay, zero COVID over. $10 on the oil price. I mean, we're one step away from China being a big bull here.
No, probably not. I mean, positive on the stimulus is correct. That's what I've been and still am, but negative on the Chinese underlying economy. Now, one of the things I was in, at least in the vicinity in Singapore, one of the things that I've learned in the meantime is that this is really apparently a very deep running conflict on the political side between the president Xi Jinping, who has stoked his entire sort of political cloud on the zero COVID policy. and cannot easily back off from it. And the prime minister, who sees the economy deteriorating much faster than he would like to, and anybody would like to, and is in support of putting in place the conditions for a stimulus. Now, the thing which we have always consistently overlooked in our discussions, I think, is we always mentioned this party congress, which is coming on secret date, October, November, which will cement the president's claim to be Mao's successor, the first one who has 3 periods and all of that, which is terribly important there in the political scheme of things. I had argued the stimulus would come shortly before in order to give an economic boost and to go into this party congress with flying flags and all of that, until people in China pointed out to me that you cannot really have an effective stimulus with an economy in lockdown. And given the political environment I described, he's unlikely to agree to a political lockdown before the party congress. First, he needs to celebrate victory over COVID. And so it's much more likely that we go to the party congress with sort of the handbrake still on, the car not racing as fast as it could. And then you see the replacement of all these people, which will be replaced. And then with the new leadership in place, you will see the stimulus, which puts it towards year end. When it comes and it is big, yes, that would be a big boost. But on the other hand, that will also a period in which the oil markets have, quote unquote, deteriorated further. And what Adi said, I agree with backwardation on that. The picture in oil markets, you can put it together very succinctly, actually. There's a long-term downward trend. There's simply a situation now in which every consensus forecast is the rest of the year, supply larger than demand. And you see that trend, you see volatility still, but it's jumping 95, 100, 94, 99, 93, 90. It's no longer jumping 105, 110, 106, 111. So around that trend. Then there are safety voids in the system. There is a SPR release, which is still taking place. There's OPEC, core OPEC countries with spare capacity, OPEC countries under sanctions still, which could be activated by political fiat, and shale in the US, which could be ratcheted up. So 4 safety margins, more or less political variables, which can be implemented. And all of that explains why prices sort of have a tendency to go down. But on the other hand, all these margins and the spare capacity are very thin. So just like Adi said, any kind of surprise, any geopolitical surprise, anything happening in Kazakhstan, anything happening with Russia and so has the potential for huge price spikes. And that's also true for the Chinese stimulus. And now add to this mix the situation in Russia. 5th of December, the European Union will stop importing seabound crude oil. 5th of February, they will stop importing refined products from Russia. And there's still this discussion, American discussion of having a price cap. Idea of this happening, you cannot rule out Russia sort of tightening the thing a little bit to keep prices up, and then there is this potential for volatility. That's why the downward bet is not becoming much more of a general theme, because people are still worried to take it because of this thin margins which make price spikes possible at any point in time, given any kind of surprise.
Adi, again, your thoughts on China. We saw last month the increase in for first time in marine fuels exports out of China. Your thoughts on where they could come in to be that strong prop for a potential rally through the winter. You're on mute, Adi, sir.
Just take a little step back on China, a little bit about what Christian was saying about macro picture. Totally agree. Lockdowns, it's very hard. Stimulus does nothing. I mean, money in the pocket, if you can't go out and spend it, is pointless. But there's the other problem in China for a major stimulus. I mean, we all kind of, there's all the China experts, especially now institutes, were pointing out to stimulus. The problem is that China also has a problem with inflation as well. Inflation is showing up, and I think they also have to worry about it. Like everyone else, inflation impacts more the sort of the poorer people, and you don't want to have the discontent going into this November conference of Xi. So I think China is also having a lot of problems, like we do here in the West. The growth has been slashed. I think saw it yesterday somewhere. Goldman Sachs, I think, slashed the growth for this year for China for, I think, from 3.3 to 3. I mean, this is pretty shocking. I mean, we're used to China growing, upward towards 10% per year, 6, 7.
Yeah, but when you take the sort of bearish piece on that, and that has been right through the year, 6, no 5, no 5, no 4, so no, it's 3. Ultimately, the moment that shifts the other direction, no, actually, it's for the reversal of China. Ultimately, the point I'm making, we're already hearing very strong gremlins that the premier last week coming out saying we have to coexist with COVID, we have to have balance with the economy. You know, the start of that narrative, and then inevitably the shift towards the rest of the world's coexisting with COVID. That could be quite substantial for the energy markets, for all commodities.
Well, it could be, and I think China is the key. I think when it comes to commodity markets, we say, well, when the China sneezes, everyone else gets a cold. It used to be United States when it comes to interest rates, and it still is the case with the interest rates. But China is the key, and to be honest with you, I'm just not sure. I expected China to pick up late this summer. They didn't. We're still going into this conference with very low growth. Still have this zero COVID policy. I don't see much of a change at all. And it seems to me that probably Christo is quite right, that I think she also feels fairly comfortable, fairly strong that he can continue with these lower rates of growth while still in power. So as long as he feels comfortable he can continue, that will probably continue. And now we're seeing that the only question is now, is China actually turning to these rates of growth similar to other developing nations like what we do? Is it for the long term or not?
Well,
Christoph, just to come in on that, bringing in the other piece, the puzzle. OPEC new Secretary General had his first speech last week. He made sort of sounding similar to what I'm echoing, but speak to the point again. Oil prices falling at a time when idle supply is closer and closer to zero. 5-year inventories are still well below 5-year averages. And while those two things coexist, can the market really drop that far?
The market can drop, and there have been people who have been saying that all along. The supply situation is not as bad, and as I pointed out earlier, there are sources where supply could come from, and if demand in the US and in China sort of doesn't improve considerably, then inventories can be restocked gradually. The risk is the risk of disruptions from the political side. But even there, even the talk about Russian sanctions sort of all settles down. The Russian discount normalizes, and that in turn would have an impact on the Chinese ability to increase the inventories. But to your point, number one, inventories are low. That's true for the measured OECD inventories. That's not necessarily true for what we have in China and India now. And these are the growth areas. Now, I'm sure the Chinese have been restocking now for a long time at every opportunity, and their demand is slowing. So that's a counterexample. And then I think that the possibility of spare capacity in OPEC is still at the 2-3 million plus, hasn't changed. And when you put yourself in the shoes in OPEC, they have two principal goals. One is they like the prices where they are. They like 100 better than 80, and that's obvious. So this is not about stabilizing the market, but for keeping a floor in prices. And then number two is very important. They have a difficult balancing act because they want Russia to continue to be part of the organization. They don't want to lose the plus in OPEC plus. And the very, very, very last thing Russia needs at this juncture is lower oil prices. So that goes some way in explaining this keeping the need to keep the organization together and the need to stabilize prices. That's what we are seeing. And on China, I think, yes, this might be a very, very strong stimulus when it comes after the Congress, but it's a high risk. That's a high-risk undertaking. There's huge reasons for instability in the Chinese financial sector, in the housing sector, with the zombie banks, all of that. There's inflation creeping up, it's true, but it's even worse is this financial instability. So it could be that China is in for a financial crisis. And one statement I've never checked, but which people always say, is that there has never been a developing economy sort of successfully catching up in income levels and industrializing without a financial crisis. So why would China be any different? And then we would have a real problem on our hands.
Adi, just speak a little bit. I mean, we're now obviously talking, we're the markets, we're trading soon, October, will be delivery, November. We're nearly getting to the point where we're talking about physical oil, into the new year. And when you look at that, I wonder, we've had some rumblings over the summer, the month we were off, about, crossover where fuel oil, where oil becomes a commodity for burning for power, potentially over the coming months, where that might add extra demand. Just speak to those thoughts.
Well, absolutely. I'll just take one again slight step back on what Christoph was saying. OPEC situation is going to get very interesting. If Christoph is right and the market continues to be weak, we already see Russia as a top supplier to China. And the weaker the market gets, the more problems OPEC will have with having Russia within OPEC. I'm not sure. I don't think that anyone in OPEC proper is too happy to see Russia as a top supplier to China, the sort of what's been seen as the major growth market for everyone in the Middle East. So I think if we see weaker
and increasingly the bigger supplier by a larger amount.
Absolutely.
So the forthcoming deal is visible, right? Russia cuts production, that decreases, that keeps its share and exposure under control, and everybody's happy. That's what's going to happen.
Well, yeah, I think probably what will happen, Christoph, is that Russia will, one way or the other, have to drop their production, because once the European sanctions kick in, as you said, on December the 5th, and then Russia will probably just advertise it as a probably cut.
So Adi, what do you know, just when I may ask, because about the big unknown, there's always this hidden target of sanctions against Russia, that if volumes goes down, fields get damaged, and it will be impossible for them to bring it back. Where does this kick in, and how strong is it?
Well, it's $1 million question. I think a bunch of Russian Urals, where the Urals comes from, a bunch of the fields are actually very, very old fields, and those fields can easily get damaged. Once they shut, they're very hard to get back. Probably the best answer to that question would be 2020, when Russia did cut its output, and it took them about 2 years, year and a half, to bring their production just close to where they were prior to the pandemic. It was extremely hard. And now with this additional sanctions, any new fields, anything that's a little bit, Russia can maintain their own production quite easily with their existing technology. I think the problem kicks in when it comes to sort of more difficult wells, like somewhere closer to Arctic, some new, more complex wells. I think without Western technology and spare parts, I think they would really struggle to do that. And I think long term, as I think I saw somewhere, Carol was saying, Russia is on the long term on sort of downward trajectory in terms of their production. I think they are probably peaking where they are right now.
Let's just sort of shift the conversation a bit, and I would agree with some comments in the chat room that says we haven't seen much Russian oil disruption yet, and whatever happens with sanctions, that still won't happen across the winter. But Christoph, I wanted to get in before we have to wrap up about the outlook for the Fed and interest rates and inflation and recession. We have the infamous Jackson Hole central bankers meeting this week, with a big speech by Fed Chairman Powell at the end of the week. Your thoughts on where all of those pieces are currently intersecting?
I think we are in a better place than we have been when the Fed was denying inflation. And I think this is for two reasons, because markets have now worried about this problem so long, and have heard about it so long before the Fed acted, that at the bottom of their hearts, everybody knows they have to act. Everybody knows this will mean sort of a stop to this enormous growth in stock markets, which we have seen over the last years. But everybody knows that this is probably long-term good news. And so the reactions has been quite moodly, actually. And secondly, everybody is also aware of the historic experiences. Nobody wants stagflation. Everybody knows about the recession risk. And meanwhile, you have come out of COVID. You have this Ukrainian discussion. You have a workforce which has turned extremely flexible. So I think that the at least within the US, maybe not Europe, but there's flexibility in adjusting to this interest rate shock is extraordinarily high, and that's good news. Now the risk is that the Fed is overshooting on the other side. Because there will be, if I'm right, there will be a softening of the impact on inflation from energy markets, which is a substantial part of these very high aggregate numbers. And that means there will be a chorus of voices coming saying, oh, inflation is going down and the Fed should relax. And of course they can't, because the underlying problem is still there. Core inflation is unchanged or rising. And the real problem is inflationary expectations. You don't want what we are seeing now here in Germany, wage negotiations where trade unions say, we want an inflation adjustment, because that perpetuates the spiral. Mm-hmm. And so for that, to break that, the Fed will have to step on the brakes a little longer, and they may well overdo it. But by and large, I think you were this ones who said, okay, then there's a recession, so what, because it will be very shallow. That's true. A recession with 3.5% unemployment, you can take it any day.
Well, half the states in the United States, employment has dropped below 3%. Unemployment is...
Yeah, there you see how economists measure things. You look out of the window, you don't see them. So that's one of the problems we have in this profession. And I think that's the most likely scenario right now, that we don't get a really deep recession in the sense of people standing in street corners and begging for money. We may have slowdown in growth, but it's all on a very comfortable level.
Adi, we had over recent weeks fairly dramatic language out of the UK central bank governor, probably the sort of scariest yet in terms of the big central bank leaders. The outlook for the UK quite negative into Europe. Your thoughts on where those pieces intersect, inflation, recession, interest rates, and what they mean for the energy markets?
Well, as you guys know very well, UK is in a bit of a pickle at the moment. The inflation rate is very, very high. Already we've hit double digits. We're going for, as Bank of England said, well over 13.5% by the end of the year. I think this is the key, that inflation is to stay with us for a while, both in the US and the UK, unfortunately, and Europe. Even though the energy prices have come down, the problem is exactly what Christoph said. We have postal workers in the UK who were offered 5.5% pay rise, and they declined it. So once you have these pay rises over close to double digits, I mean, you're going to have inflation whether you like it or not. That's the key. So what is going to happen, and I think this is very important for the oil market, is that we will see, as the Fed said, they'll do what it takes to bring it down to 2%. Now, in spite of, with low unemployment, it's very difficult to get that inflation down so easily without major increases in interest rates. And I'm afraid that we are going to see some large increases in interest rates still to come. Because if you have inflation at, let's say, double digits, we are now at what, 2-ish%. I mean, it's a long way to go just to make them neutral. So what that does is that will put a big dumper on commodity prices. And I think that's one of the reasons. China and rates of interest were two key reasons, I think, for the oil market to be where it is right now. Because it's very expensive to borrow money. You have higher expected rates of interest, and you also have due to volatility, high margin calls. So if you want to speculate in commodities, you better make sure that actually that price is going up once you've paid all these costs for speculation. So people are not going to get very long anytime soon, and that includes a lot of funds that actually use oil for hedging purposes.
Christoph, just sort of closing comments on this week coming. We could have supposedly again, Groundhog Day, Iran deal. Your outlook for that? Is that already now baked in this oil price?
It's not baked in, but we could have it. I think the probability is climbing above 50%, and the reason is that my understanding is that the US has been working very actively on that for quite a long time now. This was Biden, when he sort of did whatever it takes. He was friendly to the shale industry. He came to Saudi Arabia. He tried to kickstart the negotiations with Iran, and Iran also sees a possibility now. These things on the periphery around Russia, Turkey, Iran, and so they all start moving for obvious reasons. Because when you have these two blocks facing up, then there's some open waters in between where you can navigate, and that would increase the situation I tried to describe earlier: the tendency of an aggregate excess supply and of having safety valves which can be switched on if necessary. Iran would come back within a year by 1 million, and it would be staggered approach, of course, and some of it is already coming back, but it would certainly make a difference. And the key the impact on oil market really is Russian volumes. Is Russia capable to cut, or is it incapable to cut because it would damage his fields, and where is the threshold? I think the situation is more dramatic than what Adi said and what the markets imply. I remember when Russian output collapsed, when the Soviet Union collapsed, it took them 20 years and huge amounts of Western investment to come back. And I remember that what Adi referred to since 2020, the increase, which compensated, was coming from new fields, not from restoring the old ones. So when the Druzhba pipeline, and where it originates from, is shut, which the Europeans missed, but if that ever happens, then I think we will see an impact on volume, and then you see the squeeze happening with prices low and volumes low, and then pressure from OPEC will indeed, as Adi said, will increase to stabilize prices, and it will increase on Russia as well.
Adi, just last word with you. The dollar, we're now seeing the dollar at parity with the euro, putting down, we're also strengthening against most currencies. The yen is, off on another planet. Where does that play into this equation, do you think?
I think it's very important. Dollar index has always been something I've watched very closely when I traded oil. Very often you have strong inverse correlation between the two. Obviously, the stronger the dollar for everyone outside the United States, the imports of oil become far more expensive. And people are cutting driving. And there's a lot of anecdotal evidence in the UK that people are driving a hell of a lot less already. And I think that's probably the case elsewhere in Europe. So that we are going, there is a very, very high risk, and this is something that OPEC should worry about a lot, of us going back into sort of 1980s. 79 shock is actually not dissimilar in many ways in terms of the extent from what's happening now. Then we had major recession, a lot of government policies aimed at cutting demand for energy. Probably recession mild, or whatever recession it turns out to be, some sort of recession is quite likely, and that we could have a very big fall in demand, and that's something that we have to watch very, very closely.
Well, we'll have to wrap it up there. Some big developments in the week ahead. I think, obviously, notably Iran deal, if indeed it does happen. The Jackson Hole commentary, the sort of direction of travel for interest rates, whether they're going to remain at these sort of tightening levels where they go. We have our forecast that we did ahead of the summer break. What will Brent crude oil price be at the end of summer holiday season, August 31st, and very split room, 90, 100 and 110 all having equal. There's a week to go. Where will it end up? At the moment, it's just pipping closer to 100 than closer to 90. But of course, we know that can change in half a heartbeat. It does seem that some of the big trends coming, our first winter of the Ukraine war, I think, is going to deliver some very dramatic images and realities, people freezing in their homes and other such things, and with the lack of idle supply, even with inflation barking on the sidelines louder and louder, can energy prices fall that far when so much is geopolitically elevated, never mind demand? So these are things we're all going to have to navigate in the weeks and months ahead. Christoph Ruhl, thank you so much for coming back to the table. Adi Imsirovic, really great to have you. And of course, we'll start sort of barking loud ourselves about the must be in Fujairah the first week of October. If you're not there, you're not cool, so to speak, or some version thereof in the energy markets. But we'll all be very busy with so many live event gatherings, starting with Gastech early September, going to be a massive gathering in Milan, and there the dominoes will fall across the world with so many different. It'll be interesting to see how all those gatherings that are kind of first time in a few years sort of play into all this noise. Thanks, Christoph. Thanks, Adi. Catch up. All the best.
Take care.
All the best. Thank you.